Hey guys, this is Nick from forexnoobs.com with an anti-live trade video. Today is Tuesday the 3rd of July 2012 and the time is 4:19 GMT plus 1. You're looking at a Euro USD 8-hour chart. Now, I called this an anti-live trade video. The reason I'm calling it that is one of the members of the advanced course just asked me if they should enter this trade here. So we've got a strong bearish preceding trend, we've got indecision here, and we're getting what looks to be the start of a reversal trend. So it looks like a pretty good reversal setup. But there's a reason you shouldn't enter this trade. So I thought in this video I would enter this trade and show you why it's doomed to fail from the start. So I'm entering on a demo account obviously because I'm not going to cost myself any real money. But I'm showing you how a trade like this is doomed right from the start and how it probably is going to fail. Now, there is a small chance that this trade's actually going to work out, but chances are it's going to fail. Okay, so let's look at this setup in a little more detail. The entry for this trade is here at the 1.2600. Now, I like to pick psychological levels for my entries when I can, and this is a perfect psychological level to enter at. The reason being is that it breaks the high of the indecision candle here. So you've taken out the high of the indecision candle. That's already a good signal that the bulls are taking control of the market. And then it breaks a psychological level. Now, psychological levels, they provide support and resistance because as humans, we're fine-tuned to look for patterns and we place our stop losses around these rounded numbers. 1.2600, we're more comfortable placing our stop losses and our entry orders at these levels. And that's why these psychological levels have an impact on price, because you'll often find stop losses and entry orders grouped around these levels. So if the bulls are able to take out the stops at these levels and keep going, then that indicates that they are strong enough to push up and hit our target. So the entry for this trade is going to be the 1.2600. So if this trade is actually entered, because it hasn't really triggered yet, I'm going to be opening a long position with 5 lots, which is my normal amount traded, and that would be a bullish position, so it would be a buy. Now, where's the target? And that's where the problem comes in for this trade. This trade is way too close to resistance. This is resistance up here. This is a nice strong resistance area. I've had it placed on my chart for quite a long time. So this area is probably going to provide some resistance, and if price comes up and hits this area, it's only 26 pips from the entry at the 1.2600. So when you factor in spread and all that, let's just call it something like 22 pips. The maximum amount of pips you can make before resistance is met is 22 pips, and that's not enough for an 8-hour chart trade. It's not even enough for a 4-hour chart trade on Euro USD. My minimum target on the 4-hour chart is usually 30 to 35 pips. On the 8-hour chart, I'd be looking for something more like 40 to 50 pips. So there just isn't enough pips available in this trade before it hits resistance. The risk-reward ratio is way off. So that's the reason this trade is doomed to fail. You're pretty much buying into resistance, and the resistance area is a sell area. There's a group of sellers here waiting to push the price down. So the resistance area is a sell area, and it's never a good idea to buy into resistance. That's why this trade's doomed to fail. But I'm going to enter it just to show you exactly how things are going to pan out. So I'll update as this doomed trade progresses. Okay guys, as you can see, our entry level has been broken, so I'm going to enter a long trade right here. Going along with 5 lots here. Now I just want to make it clear, this trade also formed on the 4-hour chart. So we could see it here on the 4-hour chart. Let me zoom in real quick. I just have been trading the 8-hour chart a lot recently, so I tend to look at trades more on the 8-hour chart. But this trade has also formed quite nicely here on the 4-hour chart. We've got a nice strong preceding trend. We've got indecision here, 2 indecision candles, and we've got the beginnings of a reversal trend. And this candle here, this new candle, is the candle that triggered my entry. So this trade is formed on both the 8-hour and the 4-hour chart. I'm just looking at it on the 8-hour because it looks a little cleaner on the 8-hour, And I'm finding that a lot of trades look cleaner on the 8 hour. They're easier to spot, easier to trade, but that doesn't mean that the 4 hour isn't a good chart to trade. It's just because the price action is more compacted on 8 hour charts, it just looks cleaner and it's easier to spot those trades and to enter those trades and all that stuff. Anyway, so I'm long on this doomed trade. Now what's important to watch out for is what happens when price reaches up here, because my prediction is it's either going to reverse or it's just going to get stuck along here and bounce around for quite a while. It's just going to have trouble there, and that's why you shouldn't enter this trade. It's always a bad idea to buy into resistance. You don't buy into resistance because resistance equals sellers. So you don't buy into resistance because you're buying into a large group of sellers. Pretty logical stuff, but a lot of new traders, they don't quite understand the whole concept. So anyway, I'll update as this doomed trade progresses. Just another quick update. I forgot to mention targets and stops for this trade. So the first target is going to be up here at around about the 1.2630, because this is the start of this resistance area here. The first target has to be here at the resistance area, because we can't count on price getting too far into the resistance area, because resistance, as I've said many times in this video, resistance equals sellers. So we can't count on buyers getting too far into here. So the first target is here, which would give us around about 22 pips profit, something like that. The stop loss in this case, it has to be at least down here. Now that's going to make it a 35 pip stop loss. The reason I'm putting it down here is because I want to get it below this candle here, because if the bears manage to make a new low below this candle, that would suggest that this trade is over, because the bears are making a lower low, a significant lower low. It means they are in control of the market. So we could already see a major problem with this trade. You got a stop loss of 35 pips and a target of 22 pips. That's just not going to work out. It doesn't balance out. The risk reward ratio is just way off. So this trade right from here, from this point out, is a bad trade, doomed to fail. I mean, it could possibly work out. The bulls could just take control of the market and push straight up through here, and it could be a good trade. But taking a trade like this is a major liability. You're taking a major risk on, and this is why I advised a student in the advanced course not to take this trade. I said that this was a bad trade, and it is. It could end up being profitable, but you can't just take bad trades like this in the hope that they end up being profitable, because most of the times they won't. And even if they work 50% of the time with a risk reward ratio like this, 35 pips risk for 22 pips gain, even if it works 50% of the time, you know, you're still going to lose money. So as I've said right from the start, this trade is doomed, but we'll keep watching it. We'll see how it pans out. I'll update as this doomed trade progresses. Okay guys, just a quick update here. If you remember, this is where our stop loss was, and as you can see, the stop loss was hit. This trade was closed out minus 35 pips before it hit the target. So this trade is now officially closed out and it's over. I'll be adding another part of this video and explaining in detail why this trade was a bad trade right from the start. Hey guys, so it's been about 24 hours since this trade was closed out. I waited this long to shoot this last part of the video because I wanted to show you how the candles formed after the trade was closed out. So this was the trade here. We had the nice strong bearish preceding trend, the indecision, as I'm sure you remember. The trade was entered around about here on this candle, and it was stopped out down here from this candle because the stop loss was just below this level, somewhere around there. The target was up here, so later the target was in fact hit, but the stop loss was hit first, and as you remember, the target was something like 25 pips. Stop loss was something like 40 pips, 35 pips. So stop loss was bigger than the target. And as you can see, the target was only barely hit. It was just touched by 1 pip, and then price pushed back down. So this trade was just not good. It didn't work out. Stop loss was hit before target was hit. And even if your stop loss was a little bigger, the target was just barely hit. It was just 25 pips there. It was just barely hit before the price came back down. So this was a horrible, horrible trade. Now I've already touched a little on why this was a horrible trade, but to explain properly why this was just a very bad trade, I'm going to switch over to this very cheesy drawing here. Remember how I was saying earlier that buyers, aka bulls, are lined up here at the support area? Well, here they are. The bulls are lined up here at the support area, and you guessed it, resistance equals sellers or bears, and they are lined up here at this resistance area. Visualizing the Forex market as a struggle between the bulls and bears is hugely beneficial. See the bulls down here? They are born to buy. Every particle of their being, everything wants to buy. It wants to run up forever and ever. If there were no bears in the market, the bulls would go up at the speed of light until the end of time. But the problem for the bulls is that bears exist, and every particle of the bear's being wants to push down. They are built to short, and if the bulls weren't stopping them, they would drop until the end of time at the speed of light. The bulls and bears are locked in this constant struggle. They are constantly fighting each other. So how does this apply to this trade? Well, there are always large parts of a chart that have larger groupings of bulls or bears, and an area on a chart with a large grouping of bulls is known as support. An area with a large grouping of bears is known as resistance, as you see down here. Support, large grouping of bulls; resistance, large grouping of bears. And this space in between, it's kind of like a large open grassy plain. There's nothing there. I mean, sometimes the price struggles in between this area, but most of the times this is just a large open area where the price can move through quite freely. So when you trade a bullish reversal trade, like the bad trade I took, that was a bullish reversal trade. When you take a bullish reversal trade, you want to enter from down here where the bulls are strongest. You want to enter where the bulls are strongest because you're going long. You want to run with the bulls. You want to push up with the bulls. So you want to enter where the bulls are strongest, and you want to sell where the bulls are weakest. So where the bears are strongest up here is where the bulls are weakest. You want to buy down here. You want to sell up here. If you're taking a short trade, you want to sell up here and buy down here. So enter here, exit here, like that. Because if you buy down here, the bulls have this huge grassy plain to cross before they meet resistance from the bears. But if you buy up here, like I did, the bulls aren't strong here. They don't really have much power here. The bulls have power down here, but up here, the bulls don't have much power. Up here, you're closer to where the bears have power. So if you buy here, it's not really a smart trade. You're buying into resistance. You're buying into a large group of bears. Remember, every particle of a bear's being wants to push down. They want to push the price down. And if you're going long into a large group of bears, that's just a bad trade. I mean, it's possible for the bulls to still be strong here and to push through, but it's a gamble. It's a high risk trade. If you buy down here, your chances are much greater because here you know that the bulls are strong and they have this huge space to move through before they meet resistance. But if you buy here, they don't have a huge space to move through before they meet resistance. They have this tiny little space to move through before they meet resistance. So buying here is just a bad move, and that's what I did. I bought up here, and the bulls were able to reach just there before they met resistance and they came back down. But even before they met resistance, I mean, we got stopped out because they pushed down to here. So as I said right from the start of this video, this trade was doomed from the start. What I did was I went long into resistance. I went long into a huge group of bears, and all the bears want to do is push price down. That's just not smart. It's even stupid to go long when there's a bunch of bears on top of you that just want to push price down. I mean, you're one little buyer, one tiny little bull. That's what you are. And you're approaching an area where there's millions of bears. If you think about it like that, then it starts to make sense why this trade here, it was a bad trade. It was a reversal setup. So it did look like it was a good place to go long, but it wasn't. If the reversal setup formed down here, then it would have been a good trade. Then I would have went in and I would have targeted something like 50, 60, 70 pips, and I probably would have made those pips. But going long here, not a good move. So I hope you learned something useful from this video. I'll see you around the site.